Welcome to The Explainer. Today, we're going to get real about a company's finances and figure out what's actually going on. We're going to look past all those flashy headlines and focus on the one thing that decides if a business can weather a storm or if it just suddenly sinks. And that one thing? It's cash. So let's just jump right in with a question for you. Can a company that's making a profit, on paper it looks great, can it actually run out of money and go bankrupt? Just think about that for a second. It sounds crazy, right? Totally impossible. But believe it or not, it happens all the time. And the secret to understanding this whole paradox? Well, it's hiding in a financial document that, honestly, most people just completely ignore. Which brings us to our first section, the profit versus cash puzzle. We're about to see exactly why that big profit number you hear about can sometimes be a bit of an illusion, while the actual cash sitting in the bank, that's always the reality. Okay, so meet the two main characters in our story today. On one side, you've got the income statement. It shows you the profit using something called the accrual method. And on the other side, you have the cash flow statement, which shows you the real cash using the cash method. As you can guess, they tell very, very different stories. So, what on earth is this accrual method? Well, think of it this way. Transactions get recorded the second a deal is made. So if you sell something, but let the customer pay you later, the income statement throws a party and says, "Hooray, we made a profit," even if you haven't seen a single rupee of actual money yet. It's all just profit on paper. But the cash method, it's much simpler. It does not care about promises or invoices. A transaction only gets recorded when cold, hard cash actually moves. It either comes into the company's bank account or it leaves. That's it. No fluff. Let's make this super clear with an example. Imagine a cement company makes sales worth 1 crore rupees. Great. The income statement proudly reports 1 crore in sales. But hang on a second. Only 60 lakh of that was paid in cash. The other 40 lakh is basically just an IOU. So the cash flow statement comes along and tells the real story. Only 60 lakh rupees actually showed up. See the difference? And here is the bottom line, the most important thing to get. The cash flow statement doesn't mess around with what might happen. It just tells you, plain and simple, what actually happened to the money. Now, to make this whole thing easier to understand, the cash flow statement is actually broken down into 3 simple parts, and each part tells a different piece of the story about where the cash came from and, of course, where it went. All right, here they are, the 3 core activities. First up, you've got operating. This is just the cash from the main day-to-day business. Think money from sales coming in and cash for paying salaries going out. Second is investing. This is cash that's used to buy or sell big, long-term stuff, like a new factory or machinery. And third, you have financing. This is all about money from owners and lenders, like taking out a bank loan or paying money back to shareholders. And really, you can think of each section as answering one big, important question. The operating section asks, is our main business actually making cash? The investing section asks, are we spending money to grow for the future? And the financing section asks, are we borrowing money or are we paying people back? Okay, theory is great and all, but let's make this real. We're going to take everything we just learned and apply it to a simple example from a real company, Honda, and see what kind of story their numbers tell us. And don't worry, we're not going to get lost in every single tiny detail here. We're just going to look at the final bottom line number from each of those 3 activities. We want the big picture. First up, operating activities, and we see a positive 12 million. This is great news. It means Honda's core business, actually making and selling stuff, is healthy. It generated a really solid pile of cash. This is exactly what you want to see. Next, investing activities. It shows a negative 3 million. Now, you might see that negative sign and think, uh-oh, that's bad, right? But in this section, a negative number is often a really good sign. It shows Honda spent 3 million on long-term assets, things like new equipment. They're putting money back into the business to grow in the future. And last, we have financing activities with a positive 536,000. So what does this tell us? It means that when you balance everything out, the company brought in more cash from things like loans than it paid out for things like dividends or loan payments during that year. So what's the full story here? When you put all 3 pieces together, a really clear picture starts to form. Honda's main business is making good money, they're using some of that money to invest in their future, and they took on a bit of financing to help things along. It's a story that makes sense. Okay, so let's bring it all home. What is the big lesson here? What did these numbers truly reveal about a company?
Here's what I really want you to remember. The cash flow statement is your ultimate reality check. It cuts through all the accounting jargon and just shows you the simple truth about a company's financial health.
The biggest takeaway is that profit does not equal cash. For any company in any year, the profit they report can look totally different from the actual cash they generated. Never, ever assume those two numbers are the same. At the end of the day, this whole document boils down to answering one single, all-important question. Forgetting all the noise about profits, is this business actually generating cash? So from now on, whenever you're looking at a company and you see some big, impressive profit number, I want you to just pause for a moment and remember to ask yourself one very simple question. But where is the cash? Because that, my friends, is what really matters. Thanks for tuning in.